Hi viewers, I am Dr. Velavan, Faculty, School of Management, Shastra University. To the continuation of the previous session, now we are going to discuss about the fire insurance. First, we have to know the learning objectives of this topic. So, after completion of this topic, you should be able to explain the importance of a fire insurance policy to cover against the risk of fire. Explain the features and characteristics of a fire insurance policy. Difference between fire insurance and life insurance. Explain the pricing fundamentals for rating fire insurance policies. Describe the process and procedure for fire insurance claims. Then finally, explain the grounds for determination of fire insurance policies. Now, introduction about the fire insurance business. Property loss exposure refers to the inherent risk to which the different types of property are exposed. The various risk exposures are natural calamities, fire, flood, theft, etc. All general insurance policies seek to protect the insured from the financial consequences of these risks. So this topic deals with the property loss exposures and the way in which such property loss exposures may be covered in practice. The various types of property includes buildings, personal assets, money, securities, motor vehicle, property in transit, ships, cargo, boilers, and machinery, etc. Causes of losses or perils that can be damage or destroy property are sometimes listed in insurance policies called named perils policies. The causes of loss or perils that can damage or destroy property are sometimes listed in insurance policies called named perils policies. Other policies called special forms coverage or open perils provide coverage for any indirect loss to property unless the loss is covered by a peril that is specifically excluded by the policy. The financial consequences of a property loss can include a loss of or reduction in the value of the property, loss to income because the property cannot be used, increased expenses. These are all the three financial consequences. The next, it is to be noted that in any loss situation, there are other parties in addition to the property owner who might be affected by a property loss. These parties include secured lenders, users of property, and other holders of property. Thus, the property, either personal or commercial, can be insured to mitigate the impact of financial losses to the owner. These policies include all policies classified under the general insurance capacity. In the present topic, fire insurance is discussed in detail. In other topic, we'll discuss other type of insurance. Okay. Now we'll discuss about the fire insurance contract. Okay. So what is a fire insurance contract? Definition of fire insurance contract. What are the characteristics of fire insurance contract? Everything we are going to discuss. Now the introduction. A contract of fire insurance can be defined as a property insurance agreement whereby the insurer undertakes to compensate the financial loss suffered by the insured due to damage or destruction of the insured property by fire or other specified perils during a stated period. Like other insurance contract, the general provisions of law of contract and laid down in the Indian Contract Act 1872 uh, govern fire insurance contract. It implies that fire insurance also has to satisfy the essential of a valid contract because it is also one type of the contract. This contract is also fulfill or satisfy all the essential of the valid contract. Okay. Definition of fire insurance. The Insurance Companies Act 1958 of England defined fire insurance business as the issue of or the undertaking of liability under policies of insurance against loss by or incidental to fire. Section 2, subsection 6 of the Indian Insurance Act 1938 defines fire insurance business as the business of effecting, otherwise than incidentally to some other task of insurance business, contract of insurance agent, loss by or incidental to fire, or other occurrence customarily included along the risk insured against in fire insurance policy. From the above definitions, the test of fire insurance contract can be summarized thus: it is a contract of insurance where the primary object is insurance against loss or damage caused by fire. The contract of insurance where the primary object is insurance against loss or damage caused by fire. The liability of insurer is limited to the extent of the sum assured or to the extent of damage caused by fire, whichever is less. The insurer has no interest in the safety or damage of the insured property other than the liability undertaken. So it's a contract of insurance where the primary object is insurance against loss or damage caused by fire. The liability of insurer is limited to the extent of the sum assured or the extent of damage caused by fire, whichever is less. The insurer has no interest in the safety or damage of the insured property other than the liability undertaken. Definition of fire. First, you have to know the definition of fire. The term fire in a fire insurance contract is used in its popular and literal sense. It means the production of light and heat by combustion. The combustion occurs only at the actual ignition point. Hence, there is no fire without the ignition. Loss or damage which occurs as a result of putting out the fire would be covered by the fire risk. However, fire policies do not cover the risk of fire caused by earthquakes, riots, civil commotion, foreign enemy, then rebellion, etc. Rebellion, etc. Okay. Causes of fire. What are the causes, factors? The causes of fire is immaterial However, the loss is significant. Generally, the fire waste is usually the result of two types of hazards. The causes of fire is immaterial. However, the loss is significant. Generally, the fire waste is usually the result of two types of hazards. Number one, physical hazard. It refers to the inherent risk of fire in the property which may occur due to inflammable nature, construction, artificial lighting, unheating, lack of extinguishing appliances in the property, etc. The second one is moral hazard. This hazard depends upon humans just as physical hazard depends on the property. The property may be set on fire by the owner or by any other person with his willingness or carelessness, and lack of sense of duty which may also increase the fire waste. Sometimes when the market price is going down, the owner can willingly set on fire the property to gain from the payment of the insurance company. Thus, when losses are caused deliberately and moral hazard exists. Okay. The next very, very important one is characteristics of fire insurance contract. So this is a very important question. So in many times we have discussed the same characteristics are available in fire insurance and general insurance also. Okay. The above discussion implies that the fire insurance contract, like other general insurance contract, has the following specific characteristics. Because the characteristics of the insurance are common for all type of insurance business, like fire, marine, and general. Okay, it is a contract of indemnity. It is a contract of utmost good faith. It is a contract of personal, the personal contract. Generally, the cause of fire is material, existence of insurable interest. It is an indivisible contract, then subrogation and contribution. So these are all the main characteristics of the fire insurance contract. Okay. Number one is the contract of indemnity. Number two, it is a contract of utmost good faith. Number three, it is a personal contract. Number four, generally the causes of fire is immaterial. Number five, existence of insurable interest. Number six, it is a divisible contract. Number seven, subrogation and contribution. Now we see the distinction between life insurance and fire insurance. The difference between life insurance and fire insurance. So here we have to classify and identify the difference between these two one by one. Number one, types of contract. In life insurance, it is a contract of certainty. In fire insurance, it is a contract of indemnity. The difference based on the types. In life insurance, it is a contract of certainty. In fire insurance, it is a contract of indemnity. The next one is occurrence of event. In life insurance, death will certainly occur. In fire insurance, the fire may or may not be occurred. The third basis of distinction is period of insurance. In life insurance, policies issued for 10 to 20 years. In fire insurance, policy issued usually for 1 year. The next base is insurable interest. In life insurance, insurable interest exists at the time of taking policy. In fire insurance, it must exist from the date of the proposal to the completion of the contract. The next base is protection and investment. Protection and investment. In fire, it includes in life it includes elements of protection and investment. In fire, includes only the elements of protection. The next base is premium. In life, premium rates fixed on the basis of nature of risk. In fire, premium is determined according to the type of risk involved. Then regarding surrender value, policy can be surrendered and the insured will get the surrender value as refund. In fire policies cannot be surrendered at all. Moral hazard, the next basis is moral hazard. It is very nominal in fire. Degree of moral hazard is maximum in, it is very nominal in life. Degree of moral hazard is maximum in fire. The next base is value of policy. Life insurance can be issued for any policy amount. Amount of policy cannot exceed the total value of goods or property insured in fire insurance. The next basis is indemnity of losses. In life insurance, law of indemnity does not apply to life insurance contract, but in fire insurance it is a contract of indemnity as loss caused by uncertain event is compensated. So these are all the major differences between life insurance and fire insurance. This is one of the very important question. I already told you one important question, characteristics of the fire insurance or in common insurance. The next one is the distinguish between or the difference between life insurance and fire insurance. So you have to keep in your mind these two questions are very important. Maybe in your question paper. Okay. The next topic is types of fire policies. The fire policies can be of the following common types. Okay. The fire policies can be of the following common types. One is specific policy. A specific policy is one where the insurer undertakes to make good the loss up to the amount specified in the policy, irrespective of the value of the property. For example, if a property worth rupees 20 lakh is insured for rupees 10 lakh and the actual loss is due to only 15 lakh, he can only recover the actual loss if it is equal to or loss than the value of the policy. But if his loss is more than the sum assured, he can recover only the amount of the policy. The next one is valued policy. A valued policy is usually taken when it is not easy to determine the value of the property. For example, the value of workers of art, pictures, sculptures, etc. cannot be determined precisely and easily. In the case of total loss in a valued policy, the insurer undertakes to pay the value of the property as mentioned in the policy or the declared value irrespective of the actual or market value. The next one is average policy, application of average class. So when the loss due to fire is more than that of the value of insurance, sum assured, here they have to give the loss based on the proportionate value of the application of average class. Okay. A fire policy containing an average class is called average policy. In this policy, the insured is penalized for under insurance of the property. In other words, the insured is considered as self-insured to the extent of under insurance. Example, when the property worth 8 lakh is insured for rupees 6 lakh and the loss caused by fire is rupees 4 lakh. The amount claimed to be paid by insurer will be rupees 3 lakh. So calculate the policy here, 6 lakh into 4 lakh will be 8 lakh, that is 3 lakh rupee. So the average class applies only when there is an under insurance. When there is an under insurance and a partial loss. If the loss is total, the insurance amount will be paid. The insured amount will be paid. For example, the above example, the entire property is lost. Then the claim that is 6 lakh into 8 lakh to 8 lakh will be 6 lakh. Okay. This is a formula they have to use to discharge the insurance liability. The next policy is comprehensive policy. Comprehensive policy. This policy undertakes full protection not only against the risk of fire but also against the risk of burglary, riot, civil commotion, theft, damage from pest, then lighting, etc. Lightning, etc. The policy is also termed as all insurance policy. The comprehensive does not, however, means that every type of risk is covered. Okay. So only the limited risk only covered under this policy. The next one is adjustable policy. This is a policy issued on the stocks of the businessman with liberty to the insured to vary at his option. The premium is adjustable pro rata according to the variation in the stock. This policy is issued for the definite terms on existing stock. Whenever there is variation in the stock, the insured informs the insurer. As soon as the information is received, the policy is suitably endorsed and the premium is adjusted on a pro rata basis. Thus, the policy amount changes from time to time. Next policy is rent policy. This policy protects the business owners against the loss of rent. If a tenant does not pay rent because of fire, the insurance company will pay for such loss. Such a policy may constitute a separate policy or can be included within other forms of cover and may be effected either by the owner or tenant or by an owner occupier. The next one is transit policy. A transit policy covers goods in transit from one place to another by rail, road, air or sea transport. Under this policy, the insurance company promises to make good the loss or damage to merchandise while it is being moved. The next one is builder's risk insurance. These policies are issued to protect against fire loss to buildings, including machinery and equipment, in the course of construction and to material incidental to construction. This policy is called as a contractor's risk or contract work risk policy. The next policy is excess policy. Excess policy. This policy is suitable for those businessmen who deal in different stocks of goods in their usual course of business and whose value of stocks are fluctuate from time to time. Such businessmen take two policies, namely loss policy and excess policy. Loss policy is taken for the minimum value of stock which is held always. The excess policy is taken for the excess value of stock which may be held at any time over the minimum stock within a stipulated period. The next policy is sprinkler leakage policy. This policy insures destruction or damage due to accidental discharge or leakage of water from automatic sprinklers installed in the insured premises. However, the discharge or leakage of waste due to heat caused by fire, repair or alteration of building, sprinkler installation, earthquake, war or explosion are not covered by the policy. Blanket policy. This policy is issued to cover several properties or all assets fixed as well as at the current location of the insured under one insurance. More than one type of property in one location or one or more type of properties at several locations can be covered under this policy. The next policy is the minimum value with discount policy. This type of policy is taken for a maximum value with the discount policy. This type of policy is taken for a maximum amount and full premium is paid thereon. At the end of the year, in case of no loss, 1/3 of the premium paid is returned to the policyholder. Generally, this type of policy is not issued on all type of commodities and is confined only to selected commodities. So maximum value with discount policy. This is very important policy. This type of policy is taken for a maximum amount and full premium is paid thereon. At the end of the year, in case of no loss, 1/3 of the premium paid is returned to the policyholder. Generally, this type of policy is not issued on all type of commodities and is confined only a limited commodities. The next policy is consequential policy. Under this policy, the insurer agrees to indemnity the insured for the loss of profit which he suffers due to dislocation of his business as a result of fire. This is known as a loss of profit policy. This policy covers the following: loss of goods or property damaged, loss of net profit, outstanding expenses like interest on debentures, salaries, rent on building, etc., prepaid expenses. Then the following types of fire insurance policies are explained in greater details. Okay, so the consequential loss policies cover only the following 4 areas. One is loss of goods or property damages, loss of net profit, outstanding expenses like interest on debentures, salaries, rent or building, etc. Then prepaid expenses. Okay, the next policy is standard fire and special perils policy. So here you have no scope and coverage of cover. Okay, the standard fire and special perils policy can be issued to cover standard fire risk as well as the certain special perils. There are 12 different types of risk covered under this policy. Okay, so regarding scope and coverage of cover, the standard fire and special perils policy can be issued to cover standard fire risk as well as certain special perils. There are 12 different types of risk covered under this policy. Fire, number one is fire, lightning, explosion and impulsion, aircraft damage, riot, strike, then malicious and tourism damage, storm, cyclone, then typhoon, tempest, hurricane, tornado, flood, and inundation, STFI. Then impact damage by rail, road, vehicle or animal, substance and landslip including rock slide, bursting and other overflowing of water tanks, then apparatus and pipes, missile testing operations, leakage from automatic sprinkler installations, bushfire, damage caused by forest fire is excluded. So these are all the 12 different types of risk covered under the standard fire and special perils policy. One is fire, then followed by lightning, explosion, implosion, aircraft damage, riot, strike, then malicious and terrorism damage, storm, cyclone, typhoon, tempest, tempest, then hurricanes, tornado, flood and inundation, impact damage by rail, road, vehicles or animal, substance and landslide including rock slide, bursting and or overflowing of water tanks, then apparatus and pipes, missile testing operations, leakage from automatic sprinkler installations, bushfire damages caused by fire, forest fire is excluded. The liability of the insurance company shall in no case exceed, in case of individual items, the sum insured for each item stated in the schedule. As a whole, the total amount insured, TSI, the total sum insured. Okay, this is the liability of the insurance company. Based on this condition, the insurance company will settle them. Add-on covers. So, with certain additional premiums and subject to certain conditions and warranties, there are 14 add-on covers that can be availed, such as architects, then surveyors and consulting engineers fees in excess of 3% of adjusted loss, cost of removal of debris in excess of 1% of the claim amount, deterioration of stock in cold storage premises due to power failure and change in temperature, forest fire, the impact damage due to insured own vehicle and forklift, etc., spontaneous combustion including own fermentation and natural heating, omission to insurance, insure addition, alteration, extension, earthquake, then spoilage material damage cover due to retardation or interruption of any process, leakage and contamination cover applicable to oil and chemicals only, then temporarily removal of stocks not exceeding 10% of sum insured under the policy, loss of rent caused by operation in insurance periods. Okay. Then additional rent for interactive accommodation cost due to operation of insured peril startup expansion, damage due to molten material spillage, startup expenses, and terrorism damage. So these are all the odd-off values. Then general exclusions. Here we have to know some general exclusions also. The standard fire and special perils policy does not cover the following. Number one, 5% of each and every claim subject to maximum of 10,000 in respect of losses arising from act of good perils. 10,000 for each and every loss due loss out of other perils. The excess shall apply per event per insured. Okay. Number two, loss, destruction or damage caused by war, ionizing radiation, nuclear fuel or material pollution. Third one, loss, destruction or damage caused to pollution, uh, to billion or precise stone, works of art for an amount exceeding 10,000, books of accounts, paper money, explosive, etc., stocks in cold storage, any electrical and electronical machinery appliances, etc. The loss of earnings, loss by delay, consequently loss or damage by spoilage, interruption, then cessation of any process, loss by theft during or after the occurrence of an insured peril. The loss by natural calamity, then loss due to temporary shifting of machinery for repairs, cleaning, renovation, for a period not exceeding 60 days. Expenses in excess of 3% of adjusted loss in respect of architecture, then surveyors, engineers fee, 1% of claim amount in respect of debris removal. The next policy, reinstatement value policy. So reinstatement simply means replacement of lost property or repairing damaged property. The costs in relation to the fire insurance policy are fixed assets like buildings, machinery, furniture and fittings, etc. The reinstatement value policy is the standard policy with the value reinstatement clause. The reinstatement clause of the policy states that in the event of loss, the payment to be made to the insurer will be the cost of reinstating the same kind of property by a new one. Unlike a standard policy where the insured can recover only the depreciated value of the insured property, here the insured is entitled to recover the cost of replacing the lost or damaged property. The conditions governing the reimbursement, the reinstatement by insurer and stated in condition 7 of the policy. The following points are considered in a reinstatement value policy. The insured shall, number one, the insured shall intimate the insurer about his interest in reinstating the property within the time allowed. Otherwise, the loss is settled on indemnity basis. Then the next one is if the insured is not interested in reinstatement, the insurer is liable only for the market value of the property lost by fire until reinstatement is carried out and expenditure incurred, the insurance liabilities and an indemnity basis. Next, the the insured must carry on the process of reinstatement within a reasonable time and completed it within 12 months after destruction of the property. The insured has to submit the plans, specifications and other details needed for the reinstatement to the insurer at his expense. In addition, when the insurer demands for such plans, it does not imply that he has chosen to reinstate the property. The insured may agree for reinstatement at a different site provided the insurer's liability does not increase. The insurer, after electing to reinstate, should put the property considerably close to what it was before the fire. The next policy is floating policy. The floating policy is applicable to the inventory of the policyholder. Some traders have stock that are stored in more than one warehouse or lying in process blocks. They may not be able to keep an account of this stock on detailed basis. Such traders can furnish the total value of all the stocks to the insurer and obtain a floating policy of fire insurance. A floating policy covers stocks located in various godowns in a single sum insured. Such policies involve higher risk and therefore higher premium. The premium charged is highest rate chargeable to the any one location with a nominal rate of located. If the stock are located in the same compound, no loading is charged on the premium. The premium may be loaded by say 25% of 3 locations and 50% of more than 3 locations. During 2007, after de-tariffing, insurers were allowed to give a maximum of 51.5% discount on the applicable rate. Now the pricing and working and the pricing and wording and terms can be decided by individual insurers after clearance from IRDA. The next one is declaration policy. Declaration policy is a special policy related to stock of the insured. It is insured in the interest of those traders who deal in seasonal goods. The stocks may have fluctuating value. During peak time, the stock value are highest, and during the slack season, their value is reduced. It is difficult to fix a sum assured for some goods. There may be over insurance if the value is ascertained during peak season, and under insurance if the value is ascertained in the slack season. To overcome this problem, a declaration policy is devised. The last policy, the floater declaration policy. The floater declaration policies can be issued subject to a maximum sum issued, some insured of rupees 20 lakh. 20 lakh. Sum insured is 20 lakh, and compliance with the rules of floater and declaration policies respectively, except that the minimum retention should be 80% of the annual premium.